Good morning all, welcome to today's seminar and thank you for joining us. The focus of today's seminar is to allow us to understand both business owners and accountants and allow you to understand, whilst you own your business, what are the best ways to tax efficiently extract money from your business to ensure you have enough personal wealth to live your best life. And if you're fortunate enough to sell your business, how much you need to sell the business for. During the webinar, Nick will first discuss what financial freedom means. Declan and I will explain how we as financial planners can help you and your clients by showing you a client scenario and the tools we use to quantify a client situation. Declan will then explain the bucket concept. We will then look at ways to extract money tax efficiently from the business whilst running it and other financial opportunities you may not be aware of. This webinar is designed to give a high-level holistic overview of some of the financial planning strategies that business owners can use, and any advice should be taken from a qualified accountant or tax advisor who will be able to advise you correctly based on your specific circumstances. We'll then look at how to value your business and what that means for potential buyers. Finally, answer any questions. I'll first pass over to Nick, who will introduce financial freedom.
Yes, good morning, everyone, and welcome again to our webinar this morning. Henwood Court are a firm of chartered lifestyle financial planners that have been based in the Midlands since 2004 and specialise in dealing with established successful business owners, largely centrally based. Our prime purpose is to understand what the best life looks like for our business owner client and then cost this and help them create wealth that allows them to achieve their objectives that they're looking to achieve ultimately for when they exit, but equally enjoying a good life whilst they're on that journey. Financial freedom is one of the biggest areas that we deal and discuss client matters with. What is financial freedom? It's the ability for you to live the lifestyle that you desire without the need to generate an income. So it's having enough. It's what we call the FU number. So this is where you've got enough money to live the lifestyle that you want without making any sacrifices, but also without having to generate an income from your business or from work. How we calculate the fund number, very rawly, we take the number that you need to live the lifestyle that you wish to live and multiply this by 20. We then add in any ad hoc costs that may be incurred, such as, I don't know, buying a holiday home, spending money on a new kitchen or gifting to the children. But also we take away any income that comes in, whether that be state pension or defined benefit final salary pensions that may be coming in. So as a raw example, if someone who is retired and spending 50,000 per annum, they need a fund of roughly £1 million. So that's 20 times the £50,000. If they're then planning on buying a holiday home and spending £500,000 on that, their fund number increases by the £500,000, so 1.5 million. And then obviously the cost of running that holiday home needs to be taken into consideration. So it's very simple. It's very straightforward how we calculate these numbers. But ultimately, obviously, this is very, very personal. But financial freedom is, as we've said in this quote here, the most valuable thing that money can buy. And having experience of working with clients for over 25 years now, helping them understand what that number is, which tends to grow in time and accumulating wealth, the multiple of 20 tends to work. In fact, it probably provides too much, because we do find the situation where many of our clients are still accumulating monies when they've exit, despite our attempts to get them to spend a bit more. So what I'm going to do now is hand over back to Matt, who will run through an actual client case study, which will help us bring to life exactly what we do with clients in terms of helping them understand how much is enough for them. Thanks, Matt.
Thank you, Nick. That was great. Thank you. So what we're going to do now is run through a client scenario. A business owner, like many, who has a very successful business, has spent years focusing on that business, the value of the business and the funds within it, but hasn't spent enough time really focusing on his own personal wealth and throwing money over the wall. And by that, I mean extracting money from the business tax efficiently to allow him to enjoy the financial freedom that Nick discussed without having to sell the business. Then if he does sell the business, even better. Our job as financial planners here at Henwood Court is to understand you. It's not about money. Money's just a facilitator to allow you to live your best life. We take clients, all of our clients, through what we call the Financial Sense Discovery Programme. And during this time, we take time to get to know you, and to create a sort of wish list of hopes and dreams. And we do this because it's not possible to give somebody proper financial advice without firstly understanding them, their values, their goals, and what is important to them, and even their past experience of money. This element of our work is essential because it helps to foster greater financial awareness and the objectives that you have. And it gives the initial groundwork because any product solutions are totally geared and mobilized towards the achievement of your stated objectives. The client scenario we're going to look at today is John and Andrea Jones. They've come to us because they both feel they're reaching an age where John is considering retirement, but they don't feel like they're ready at all. The scenario is split into two halves. We've got the hard facts. So John and Andrea are married, they're early 50s. They've got two children, Tom and Laura. John is the sole owner of Widget Productions Limited, which has a turnover of 5 million with a net profit of £1 million. It's got £750,000 in the business bank account. Andrew does not currently work or is not currently involved in Widget Limited. They've got a gross household income of 259,000 made up from salary and dividends, which nets down to about 179,000. Their annual expenditure is approximately 130 to 140,000. Got 30,000 in personal cash deposits. A house is worth £1 million with a £500,000 mortgage. They've got two other loans and a credit card debt. The only pension provision that John has is a standard life pension worth 300,000, which Widget Limited contribute £500 per month to. So those are the hard facts about John and Andrea, but what's truly important are the soft facts. John is worried, will he ever be able to retire, and what does he need from Widget Limited to enable that? Andrea feels like John works too much and he's very stressed. John dislikes paying tax, both personally and through Widget Limited, so would like to become more tax efficient. Andrea hasn't saved into a pension since leaving the NHS, should she be? And John feels he's dedicated his life to Widget Limited and wouldn't want to let his baby go. Andrea worries that their retirement dreams are not realistic, and both feel they're financially disorganised and have no plan. What I'm now going to do is pass over to Declan, who's going to discuss some of John and Andrea's objectives, as well take you through Presswood, our cash flow modelling system.
Thanks, Matt. Crucially, we are lifestyle financial planners. Lifestyle financial planning goes beyond what we traditionally refer to as wealth, assets, net worth, and valuations. Instead, it looks at trying to understand what really matters to clients, what's their most pressing financial concerns, identifying and capturing the things they want to achieve in their lifetime, and also finding out where they want to be in 5, 10, 20 or 30 years' time. Mr. and Mrs. Jones' objectives are: we love the Algarve and dream of buying a holiday home there one day. I want to exit the business in 8 years, retiring completely. To become debt-free by retirement. We will continue to support Laura, our daughter, at university, and plan to do the same for Tom, our son. We know how hard it is to buy a house at the moment, so we plan to give both children £50,000 aged 25. We love our house and cannot ever see us moving. To build sufficient personal assets for our retirement and the ability to fund and maintain our ideal lifestyle both now and in retirement. We're now going to look at the cash flow software that we use at Presswood Truth. So here we are. This is a dynamic and interactive modelling tool that we use with all clients. We firstly start by inputting all current and future assets, income, expenditure, plus underlying assumptions, which enable us to project a client's financial position moving forward. And then we model different scenarios and stress test the strength of the plan. So let's start with the data. If we look at the net worth statement for John and Andrea, we break their net worth statement down into different asset classes. The first asset class is what we call unencumbered, readily realisable assets. This is liquid money. And in John and Andrea's case, they have £30,000 in a current account. The next asset class is business interest, which makes up the majority of their net worth statement. Widget Productions Limited is valued at 5.5 million, of which 750,000 is cash in the bank. The next asset class is pension funds. And this is what we have as liquid pension funds, not Andrea's NHS pension, which will provide a secure income in retirement. This is invested pension with Standard Life, and this is valued at £300,000. The next item we look at is liabilities. Okay, so John and Andrea have a home improvement loan at 10,000, another loan at 7,000, a main residence mortgage at £500,000, and credit card debt amounting to 3,000. So total liabilities 520,000. And the final asset class is their main residence, their home, which is valued at £1 million. So total net worth as at today, 6.31 million. If we then flick to the asset allocation tab here, again, this breaks it down a little bit more for us. So if we look at business assets, 80% of their total net worth is in business assets. Property, 15%, which is their main residence. Managed funds, just under 5%, which is John's Standard Life pension. And importantly, liquid money is very, very low. It's less than 1% in the current scenario. The next data we look at is income. So John and Andrea's income can be broken down as follows. Earned income, which is John's salary, £9,000 for the tax year. We have some interest from cash held on deposit. And the biggest income, of course, is the dividend income that John's drawing from the business, which in this example is £250,000 for the tax year. So total gross income, just shy of 260,000. This tab here, we look at net spendable income. And of course, the important item there is highlighted, the net income per annum, which is just under £175,000 for the current tax year. The next data we look at is expenditure. We have clients fill out a detailed expenditure questionnaire and helps us break down where's their money going. So we haven't broken it down in this example just for ease, but we look here at total expenditure just under 85,000. Okay. Cost of servicing debt 41,000, which can be broken down into just under 3,000 for home improvement loan, and the main residence mortgage just over 38,000. John has a PCP arrangement, okay, that he pays for personally, which amounts to 8,400 for the tax year, and we have some bank account interest reinvested back into the system. So if we look at the relationship between net inflows and net outflows, in the current tax year, 174,000 coming in and 134,000 going out, leaving an income surplus for the tax year of just over 40,000. If we look at the chart on the right-hand side, it does increase. Okay, it drops down next tax year, but it increases between now and retirement. And of course, in retirement, the inflows are lower than where they are now because they're not working. They draw down on their liquid money, and we'll talk about that a little bit later on. So now we've checked the data, we've looked at their position as they currently are. We now need to look at the underlying financial planning assumptions that we'll use to project forward, and Matt will run through those for us.
Thank you, Declan. That's great. So within the financial plan, we have to make some assumptions. Some of these are personal, what John and Andrea want to achieve, but others are financial and economic. And as we know, things change, sometimes quite quickly, as we're seeing currently with inflation. However, financial planning is a journey, which is why the ongoing service is vital for any financial planning. The financial and economic assumptions we have made in this scenario are as follows. That taxation will remain the same, legislation remains the same, John and Andrea remain in good health, they're UK residents and domiciled for tax purposes, state benefits remain at current levels, and no future circumstances changes occur. That doesn't allow for obviously personal circumstance changes. Inflation at 3%, understand it's slightly higher at the moment, but as a financial plan is a long-term plan. We're looking at that over the next 30 to 40 years. You've got national average earnings at 3%, pension fund growth rate at 5%, cash deposit interest return at 1.5%, and then property growth rates at 3%. What we cannot predict, however, are a client's personal circumstances and personal planning assumptions. And these can be anything from large long-term goals such as retirement ages, paying off large debt, or one-off expenditure like John's Rolex watch and Andrea's Cartier watch. John and Andrea knew what they wanted, and what we needed to do was price how they would get there. So if we look at the personal planning assumptions, John is projected to retire age 60. He will earn 259,000 between now and retirement, with a PAYE salary of 9,000 per annum and dividends of 250,000 per annum. Andrea does not currently work, and the assumption is that she does not return to the workplace between now and John's retirement, thus nil income. No future inheritances are expected. John and Andrea will their main residence mortgage and all unsecured debt they have clearing before John's age 65, ideally sooner. However, that's the maturity date. There will be no downsizing from this property, thus never releasing equity, and it will remain the forever home. John's business will continue to contribute £500 per month into the Standard Life GPP. At point of 60, Standard Life pension will give John maximum tax-free cash, which is 25% of the value, and sustainable income at retirement. Andrea has a deferred NHS defined benefit pension, which is projected to pay 30,000 tax-free cash and £5,000 per annum age 60. Both will receive full state pension age 67. We've assumed for this financial plan that both will live until age 100. John hopes to sell Widget Limited in 8 years' time, but for planning purposes at this stage, any potential windfall has been excluded. John and Andrea are currently fully funding both children through university, costing £20,000 per annum per child. We've assumed that you will both gift £50,000 to Tom and Laura when they reach age 25 for house deposits, and a further £20,000 each towards Tom and Laura's individual weddings, assumed to be age 30. Annual expenditure is currently 130,000. This will drop to 90,000 in retirement, falling to 50,000 at John's age 80. This will increase by CPI, and in the event of death, we've assumed that household expenditure falls by 20%, personal expenditure by 60%, car expenses by 50%, and professional fees by 20%. Children's expenses will remain the same. John and Andrea will buy the holiday home in the Algarve when John retires for 400,000 in today's terms, which will be sold at John's age 80. And finally, we've assumed that John will purchase a Rolex watch for £15,000 when he retires, and Andrea will purchase a Cartier watch for £7,000. What I'm now going to do is hand over to Declan, who's going to bring to life John and Andrea's situation and explain the bucket concept.
Thanks, Matt. Okay, now I want to share with you a crucial financial strategy. It's called the bucket. The bucket measures your liquid wealth, which is very important because it enables you to live the lifestyle you desire right now and in the future. So here is John and Andrea's financial bucket you can see on screen. What we know is that they have money in their bucket already, but only 30,000 cash in the bank. This is their liquid capital, money they can get their hands on in 7 to 10 days, and it's the money we can use for financial planning. Now, don't think for 1 minute their house is included in their bucket. It can't. Their house sits top left outside of the bucket, and they don't wish to downsize in the future. So at no point in their financial plan, at least in the base scenario, are they releasing equity that will flow into their bucket. Another thing we cannot use is John's Standard Life Pension Fund. In the future we can, because in the future he's likely to release, say, 25% of the value as tax-free cash, and that will flow into his bucket. And then probably he'll turn on an income and take an income from the pot, and these will be future inflows into the bucket. Another thing that can't be included is the value of the business, top right. John has spent many years building the business, putting heart and soul into it, and it has a real value, but until sold, it will stay outside of the bucket. So as you can see, there is wealth that they are accumulating inside, and there's wealth accumulating outside the bucket. Now, the good news is they have a regular inflow, salary, dividends from the business, and potentially a possible sale in the future will provide a big windfall coming into the bucket. In the future, they'll have 2 state pensions, and that will also flow into the bucket. It looks great. I guess you think one thing can happen, it just fills up. However, this isn't the case. There is expenditure to take account of, and that is the cost of their current lifestyle. For John and Andrew, that's estimated to be about £130,000. At some point in the future, that tap will stop and it will move to the next tap. This is the retirement tap, which is currently estimated to be John's age 60 when he's looking to sell the business. And this drops to about 90,000. The reason for the fall is mortgage drops out, a little bit of children funding with university drops out, okay? And then that tap stops at some point in the future. And that is estimated to be John's age 80. And this is what we call later life spending. So this is when life is a little bit more straightforward. The travel maybe stops, the big expenditure items, you can do less things. So life is a little bit more straightforward, and that is estimated to be 50,000. Now, on top of these taps, we have one-off expenditure items, and those are highlighted now. So for John and Andrew in the case study, that is property deposits for the children, wedding funding, and an Algarve holiday purchase. Okay. Now, our job as financial planners is to manage clients' buckets. It's to understand the holistic position and to ensure that of the three scenarios we'll run through now, which is the bucket running out of money, which is the red arrow. Obviously, that is not an ideal situation. We've got overflowing. We've got the bucket overflows. So that is where too much liquid money is building up, and essentially they've paid tax their whole life, and then they pay a lot, or their estate pays a lot of inheritance tax. And the position we want our clients to be in is the green line, a happy medium. Enough money in the liquid bucket to live the lifestyle they desire comfortably, but of course not dying with too much and then paying a lot of tax. So now we're going to flick back to the cash flow software and look at a real life example. So if we have a look at the cash flow software here now on screen, we've got the assumptions. We've got inflows and outflows in John and Andrea's position between now. We've run the plans to age 100. Okay. And this is a position at the moment. So the big inflows, of course, are the income from the business. We have excluded any windfall from the business, so that is excluded from the plan. And big outflows are the cost of the lifestyle, the holiday home, and gifts to the children, things like that. So we're now going to project forward what the £30,000 looks like, the liquid money, and how that changes over time. And here we are. So between now and retirement, John and Andrew have an income surplus of around 40,000. It changes slightly, but around 40,000 between now and age 60. So the liquid money starts to build from 30 to around 200. But of course, as they come to retire, as they look to purchase a holiday home and things of that nature, they quite quickly run out of money. Deep dive into the red, which was not an ideal situation for our clients. And we typically see this. So our job as financial planners is to work out a strategy, a way of removing this vulnerability. So if we try and answer John's question, which is a lot of business owners' question, how much do I need to sell the business for to remove this vulnerability? So if we look at some of the stress tests we've got on the side of the cash flow here, how much has John got to sell the business for, net of tax, to remove this red vulnerability? And the cash flow will work this out for us. The answer, 1.371 million net of tax. And if we show that on the chart here, this is what it looks like. Vulnerability removed. Now, another question John and Andrea want to know is how much more do I need to draw from the business over the next 8 years between now and retirement, again, to remove the vulnerability? £310,000 additional income between now and age 60 to remove that vulnerability. This really helps our clients. It provides peace of mind, clarity, and what they need to focus on to ensure financial stability and independence. Now, so we've looked at the base scenario, no business sale. What do they need to sell the business for? What do they need to draw from the business between now and retirement? This is the power of cash flow planning. So let's look at strategy now, the underlying financial planning strategy, which will improve their position. Okay. You know, we take time out to evaluate our client's position and build financial projections, but also this strategy is absolutely critical. Okay. So these ideas that I'll run through now are just high level strategies. You know, let me stress that before implementing any of these ideas, seek specialist advice, and we can explore these in greater detail. So if we look at the first strategy, bringing Andrea into the business, his wife, we would advise where possible, Andrea joins the business and fulfills a role, meaning she can become an employee and a director. Once this has been established, John and Andrea should increase their base salaries to around to maximise the personal allowance, 12,570 per annum. And this will save corporation tax, of course, for the business. Dividends, which currently are 250,000 to John, could be split equally, reducing the amount of tax paid, around 125,000 each, increasing their joint net income. Another idea, introducing alphabet shares. Alphabet shares are the most common example of different share classes seen in small to medium enterprises. Named for letters used to differentiate each class: A shares, B shares, C shares. The benefit is that each class can be given different rights, for example, weighted voting rights or preferential dividend payments. An example of class rights for alphabet shares is the payment of different dividends. If 4 shareholders each held 1 ordinary share in a company, they would have an equal right to a dividend, so 25% of any declared dividend. So our idea around alphabet shares can get around this by creating weighted dividend rights. In this scenario, each shareholder could still hold 1 ordinary share, but a different class within that. This benefits of dividends can be differential. They can be different to different people. So we would suggest, I guess, firstly, establishing a separate trading or family investment company, and then designating 5% of the business shares into this arrangement. And between now and retirement, putting around 50,000 dividends into this arrangement for their retirement, throw money over the wall for personal assets, whilst further extracting money from the business for retirement. Once this has been established, the money would be invested in that arrangement and would be used for a retirement income. Back to the alphabet shares, that we would advise establishing the alphabet shares and establishing shareholders as follows: 51% to John, 5% to the trading company, 34% to Andrea, and 5% to each of Tom and Laura. And these dividends could be now paid out to the children who own alphabet shares, which could be used to cover student education funding, increasing tax efficiency and reducing John and Andrea's personal expenditure, thereby increasing their surplus income, which can be used to build assets for retirement. The next strategy we'll look at is pension funding. Okay, this is another key strategy for them. It's crucial that John further builds his retirement nest egg between now and retirement. It's not a huge pension, and given what they want to spend in retirement, we think it's crucial he builds this. So John should look to maximise his annual allowance, including potential carry forward. We advise that Widget Production Limited should maximise this between now and retirement from company cash. So if John's company is currently contributing £500 per month into his arrangement and has historically done this, so this leaves an annual allowance for the current tax year of around £34,000 and carry forward of £102,000. So a one-off contribution from Widget Productions Limited, assuming affordability is there, of £136,000 for this tax year, and moving forward, maximising annual allowance of £40,000 between now and retirement. This would bolster John's personal pension arrangement, increase future tax-free cash and pension income, reducing business profits, so liability corporation tax is reduced between now and retirement, but also, assuming the pension is structured correctly, this is funding an arrangement which is IHT efficient. A personal pension arrangement should also be set up for Andrea when she's joined the business. And again, this should be funded, further enhancing their joint pension assets in retirement. Sticking on the idea of pensions, but a different aspect of that is increasing investment risk on the pension assets. Assuming John and Andrea have a suitable attitude to risk, by increasing their exposure to equities within their pension arrangement, which is the engine room of their portfolio, the growth elements, this could increase or should increase, assuming it is built and managed properly, their long-term investment returns. As they're circa 8 years away from retirement, they have sufficient timescale to withstand increased investment volatility that they would experience from increasing their exposure to equities, and this would further build their pension plans ready for retirement. We've assumed 5% net investment return on the base scenario that we just looked at, where they ran out of money. In the new strategy, we'll show you we've assumed 8% net, which is not unachievable, assuming it's built and managed correctly. And again, this is for a higher risk portfolio within their pension arrangements. If we look at another strategy, that would be alternative investments. Okay. Now, an alternative investment is a financial asset that does not fall part of conventional investment categories, so stocks, bonds, in ISAs and pensions. Other forms of personal financial planning should always be considered first, so that's maximising pensions and things of that nature. These investments can't be funded from the business either. That's important to note. So John would therefore need to extract money from the business, maybe in the form of a dividend, therefore be liable to dividend tax. He then may reinvest the proceeds into a VCT, EIS, that stands for Venture Capital Trust, or Enterprise Investment Scheme. On doing so, he would receive 30% income tax relief, capped to the amount of tax he pays, of course, thereby offsetting dividend tax and enhancing the money held outside the business. Again, we're extracting money from this business throughout net between now and retirement. We would suggest that John directs around £30,000 into a VCT between now and retirement, again, assuming he's got the risk appetite for this type of investment. And we've assumed 8% net growth on this between now and retirement, further diversifying his personal invested assets and reducing his tax liabilities, which is a key objective of his. Another strategy is protection. So let's talk about protection for a moment. The first item is personal life cover. John has a personal life cover with sum assured of around 2 million. We recommend this should be switched to a relevant life plan. Okay, so John's currently paying around £150 per month for this personal life policy, and it's designed to give Andrew a tax-free lump sum in the event of his passing. A relevant life plan is much more tax efficient, okay, because it's paid for by the business. The premiums are not usually treated as a P11D, benefit in kind. This means that the employee won't pay income tax on the premiums, and both the employer and employee will avoid paying national insurance on the premiums. As long as the premiums are being wholly and exclusively for the purpose of the business, they should be an allowable expense for the employer. And benefits paid through the relevant life plan trust should not also form part of the estate for inheritance tax purposes. Sticking with the topic of protection, but again, a different element is income protection. In this case study scenario, John and Andrea, there is no income protection in place. This is their biggest financial concern and vulnerability for me, looking at their position, because if John was unable to work due to long-term illness or disability, business growth would likely stall, and the business sale could become more challenging. So income protection replaces some of their income if you can't work due to illness, injury, or if you become disabled. So income protection would then pay out regular income between now, retirement, or return of work, or end of the policy, whichever is sooner. And we would recommend that John takes out an executive income protection plan payable by the business to remove this vulnerability in a tax efficient manner. Another item and a strategy that we would look at is company car. So John currently pays around £700 per month for his BMW X5 through a PCP arrangement. One consideration would be that he sells his current car and instead buys a brand new electric vehicle through the company to claim the sizable tax benefits offered by the government. Furthermore, personal expenditure would fall. So tax benefits of this type of strategy would include 100% capital allowance, meaning if John was to purchase, let's say, a Tesla Model Y for $65,000 through the company, he would save $12,350 corporation tax. He could also claim 5p per business mile to contribute to the cost of electricity. And took back to personal expenditure, his personal expenditure would fall by £700 per month and would only pay 1% benefit in kind on the electric car when he completes his tax return. Another strategy is corporate investing. Okay, so the company currently holds around 750,000 in cash, which is low yielding. Corporate investing is simply investing the profit, surplus cash in the business, instead of drawing as an income or holding as in the company current account. We've witnessed over the past year cash returns have been dismal and they failed to keep up with inflation. So while investing in the business, such as assets specific to the company, property, machinery acquisitions is probably the most profitable way to grow the business and revenue streams, cash stagnating in deposit accounts is not working for them. So therefore, John should consider investing into a portfolio, something similar to what he would hold within his standard life pension arrangement. This would be owned and held by the company. So this would further diversify into securities and give assets and give your business multiple revenue streams. Potentially increase returns on the money as opposed to held as cash, and reduces the default risk of holding too much in one account. Okay, so now we've spoken about all these strategies and implemented them into the cash flow. Let's go back to the cash flow. Let's have a look at what their projections look like. So with the cash flow here, we can overlay the new strategy. We've called it strategy adopted scenario. Okay, and here we are. John and Andrea now do not run out of money. Their liquid funds build between now and retirement at an increased rate versus the base scenario because they're throwing more money over the wall with increased pension funding, money into the family investment or trading company, and money into the venture capital trust. Of course, they still draw down on their liquid money throughout retirement because they've got a cost of lifestyle they want to upkeep. Okay, but at some point at age 80, they sell the holiday home, so that brings in a big inflow into the plan, and their expenditure falls. So importantly, the clients now do not run out of money. Okay, and again, this still assumes that no business is sold, so their financial position could be improved. But this gives the clients a lot more peace of mind. Their strategy improved, and they've implemented some of the ideas we've just spoken about. Okay, over to Nick for pre-sale business planning.
Thank you, Declan. Just in that strategy, one thing that we always do is not assume that the business is sold. We like to help our clients get to the point of financial freedom without having to sell the business by extracting monies from the business tax efficiently. And if they sell the business, which obviously is a target, then that's cherry on top of the cake. But if we do look at selling, there are options that we can look at to try and mitigate some tax prior to sale. This is very complicated, and advice should be sought from a tax professional that's qualified in these areas. But things that we've experienced our clients do in the past is, for example, put some company shares prior to sale into an investment or family investment company. Why would they do that? Well, when we sell a business, we pay capital gains tax potentially. By putting some shares into a family investment company, we may reduce that CGT that's immediately payable by that company. So effectively, it's reducing the CGT payable, assuming we obtain substantial shareholding exemption. And that money, therefore, that would have normally gone into tax, it puts it into a family investment company in which the business owners and the family could potentially draw from post-sale with all other potential inheritance tax benefits as well. So it's complicated, but again, it's been successfully executed by a number of our clients when they can afford to do this. Another thing that some clients have done in the past, again, if it's affordable, is to put shares prior to the sale into a family trust, typically a discretionary trust. Why do they do that? Well, when you sell your business, typically a business gets business property relief. So effectively, business relief means it's no longer liable to inheritance tax. So, but when you sell that business turns into cash, then sits in your estate and is liable to inheritance tax. So one way to do that is to put some of your shares into a trust, and when the business is sold, those shares go into the trust rather than your own assets, and therefore is outside of the estate, giving a potential saving from inheritance tax. But obviously, this has to be affordable. So these are things that, again, many of our clients will discuss with a recognised and highly qualified tax professional that can look at how you can achieve this if you are looking at selling in the future. And again, we would encourage looking at these options well in advance of a potential sale. Right, I'm very conscious that we have actually run a little bit over, so apologies for that. What we're just going to look at now is to see if there's any questions that anyone has following the topics that we've covered. An awful lot has been covered in today's session, so if Matt and Declan can join me now, we'll look at some questions that people may have. So if you do have any questions, there is a Q&A box where you can pop your questions in. We have had one in advance. So the question is, and again, perhaps Declan, you can answer this. How do you onboard a new business owner client?
Yeah, thanks, Dick. I'll run through that now. So how do we onboard a new business owner client? Back to the Financial Sense Discovery Program, we take a lot of time to get to know them, their personal worlds of family, friends, what do they get up to, what do they like to do, but also the business. Okay, and we get to know them in a lot of detail. We then cost that lifestyle, understand where the business is going, and we build a financial plan. So we build a life plan, and we build a financial plan and a business plan. We bring them all together, and we provide clarity, peace of mind of where clients are going. Most of my business owner clients have always wanted to know what do they need to sell the business for to be able to live the lifestyle they desire in retirement. But our job is to build that strategy so they're not reliant on that business sale. So that's the process of onboarding a new client. It's a very detailed and involved process. It's over between 3 to 5 meetings, but we get there. We build the strategies, we analyze the products or arrangements, and we build their plan, and we cost that lifestyle.
Yeah, thanks, Declan. I think just to add to that's exactly right. We sit down with prospective new clients and see whether we can add value to them first and foremost. If we can, then that value can come in multiple areas, not just in terms of potentially saving money, whether that be tax, but also making money with opportunities that may not be taken advantage of. But ultimately, it's about creating a life plan followed by a financial plan, and then just ensuring that the wealth management, the products are working for you as well. We've had a question coming from Andy. Hi, Andy. And the question is extracting cash via dividend still more tax efficient way than salary with increasing corporation tax in the future? Yeah, great question, Andy. Obviously, with the increased rates in dividend tax, they increased by 1.25% this tax year. They're becoming more and more aligned with income tax rates. So the benefits of dividends are being reduced, but obviously for the basic rate taxpayer taxed as 8.75%, it's still a lot lower than the 20% income tax rates. And as we get into higher rate tax, they do tend to still be some advantages, but not significant. But of course, dividends cannot be used to offset profits. So it does mean that we do end up paying more corporation tax as a result of this. It's a big question, Andy, and I think it's one that we need to sit down and just do the number crunching, which again, our cash flow systems can do. And it really depends on the incomes that are flowing in, whether it be multiple directors or single directors, whether families involved with those kind of things as well, and ultimately the individual's personal situation. But yes, with corporation tax rates going up, paying salary rather than dividends is becoming increasingly more popular, or of course a combination of the two. Okay, we have another question come in, and the question is, how do you cost for your services? Good question. The way that we cost for our services is when we onboard a new client, we charge a fee, and that fee is dependent upon the complexity of what we do for that client. And for that fee, our clients will get their life plan, where we deep dive into their financial position, their business, and also their world, their family, what's important to them, to create this financial plan. And that's before we've even spoken about a product, an ISA, a pension, a life policy, an inheritance tax strategy. Our fees for onboarding can be paid by the business typically, because it's very consultative, so it is offsettable against corporation tax, and they typically range from £2,000 to £3,000. To £5,000. That's £2,000 to £5,000, and that's a one-off cost. We then charge fees for ongoing services, which again may be payable by the business, subject to accountants' agreements and what we're doing, and some may be payable by yourselves or by your products. But typically, again, we have a range of fees determined by the services that are offered, anywhere from £4,000 to north of £20,000, but it's really determined by what the individual wants. One thing that we have found, that despite the fact that we tend to do more than the average financial advisor will do for a client, our fees tend to be very, very competitive. Okay, I hope that answers the question there. I think we got time for one final question that actually came in a bit earlier, and that was, Matt, I think you could answer this one. How did we value Widget Limited?
Yeah, okay, great. Thank you, Nick. So what we used a acronym called EBITDA, which you may have heard of. It's a standard measurement of business performance that banks and other financial institutions, but also the business owner, can use to value a business and to assess their profitability. So the acronym stands for earnings before interest, taxes, depreciation and amortization. It's probably best to look at an example for Widget Limited. So if we take their net profit of £1 million, they paid interest on borrowing of 100,000, they paid taxes of around 400,000, and then they had depreciation and amortization of 350,000. Just while we're on that subject, depreciation is the reducing value of any tangible assets they've got, and amortization is depreciating assets of copyrights or any intangible assets they've got. So that's what those two mean. So that gives a total EBITDA of £1.85 million. And then what we did is we used a very prudent multiplication of 3 times to get the value of the business. Now, this is incredibly prudent given that some businesses go for 8, up to 13 times their EBITDA. But what that gave was that £4.875 million figure. Now, the great thing about EBITDA is it allows businesses to value themselves and to give them a measure of profitability. And it also gives interested parties the ability to compare apples with apples if they're looking at 2 businesses they may be interested in purchasing. Finally, it does allow businesses to analyze their profit margin, because you can take turnover and divide it by EBITDA to get a percentage. And it can, if you're looking to sell in 5-8 years time, like our client scenario was, then it allows them to improve their EBITDA percentage to hopefully get more business from the sale.
Thank you, Matt. Well, okay. Right, we've now 50 minutes into our webinar. I'd like to say a big thank you for everyone who's participated and attended this morning's webinar. I hope there was some benefit there. Do accept there was an awful lot covered. We will be sending a copy of this presentation and a few other useful guides out to all participants. So again, big thank you from myself, Declan and Matthew, for your attendance this morning. I hope you found this session a benefit. Thank you.
Thank you.